Your first $5,000 in ETFs almost never fails because of the funds. At that exact number, which ETFs a beginner picks barely changes the outcome. But the diversification advice everyone repeats quietly costs the only thing that does. Here is the concrete stake. A beginner who follows the popular rule, spread it across 4 or 5 ETFs, stay diversified from day one, locks in higher fees, small tax friction, and a slow drip of analysis paralysis. That paralysis stalls the next deposit, and the next deposit is the single lever that actually builds the account. So a fair question sits underneath all of it. If diversification is the first rule of investing, why is it the wrong first move for your first $5,000? This video answers with arithmetic, not opinion. It puts perfect fund selection side by side, with consistent deposits and measures which one moves the balance by pennies and which one moves it by thousands. The advice that feels safest is the one quietly costing the most. The obvious objection lands first, and it deserves respect. Telling a beginner to diversify is not lazy advice. It is arguably the most battle-tested instruction in all of investing, and the people repeating it are usually the careful ones, the readers, the planners, the ones who did their homework before opening an account. So take the advice seriously, on its own terms, before laying a finger on it. The case for spreading a first $5,000 across several ETFs is genuinely strong. Diversification lowers the damage any single holding can do. If one fund concentrates in a sector that stumbles, the others cushion the fall. Spreading across US stocks, international stocks, and bonds is not superstition. It is the direct application of the one insight that won a Nobel Prize. Harry Markowitz's 1952 work showed, in plain mathematics, that combining assets that do not move in lockstep can raise expected return per unit of risk. That is not a slogan. It is the foundation modern portfolio construction is built on. And the historical parallel makes the advice look even wiser. Look back at the investors who ignored it. Through the late 1990s, a generation of new investors poured money into a single theme: technology, growth, the future. Concentration felt like conviction. Then 2000 arrived, and the Nasdaq lost roughly 78% of its value from peak to trough, a decline it took 15 years to fully recover. The ones who had spread across asset classes bled far less. A decade later, the same lesson repeated with financial stocks in 2008. The message hardened into doctrine for a reason. Concentration is how ordinary people lose real money, and diversification is the seatbelt that has, again and again, kept them in the game. So the advice is not a myth built on nothing. It is a correct principle, validated by real crashes, taught by serious people who watched undiversified investors get destroyed. When a financial planner tells a nervous beginner to hold several funds instead of one, that planner is passing down hard-earned scar tissue. Dismissing it outright would be arrogant. Here is where the honesty has to cut the other way. Every one of those lessons, Markowitz, the dot-com wipeout 2008, was learned on a portfolio, a real one, 6 figures, sometimes 7. The investor who lost 78% in the Nasdaq had enough capital that 78% was a life-altering number. The diversification that saved the careful ones was diversification across meaningful dollar amounts, where a 2 or 3% allocation to bonds actually held thousands of dollars, and where the difference between one fund and 5 funds changed the shape of an entire net worth. That is the quiet assumption nobody says out loud. The rule was calibrated for a specific patient. Its dosage, spread across 4, 5, 6 holdings, was written for an account where each slice was large enough to matter, and each rebalancing decision moved real money. Apply that same prescription to $5,000 and something subtle breaks. A 3% bond allocation is $150. A fifth ETF holding 8% is $400, much of it duplicating what the other 4 already own. The protective machinery still spins, but it is now protecting an amount too small for the protection to register, while the machinery itself adds cost, friction, and hesitation. The principle is sound. The transplant is where it fails. Which raises the question this block cannot yet answer, and the whole video has been circling. Was the diversification rule ever meant for an account this small? Because when you trace it back to where it was written, the portfolios, the losses, the math that made it gospel, you find something uncomfortable. The rule was written for a portfolio that looked nothing like $5,000. Trace the diversification rule back to when it hardened into gospel, and a specific decade does most of the work. The principle is old. Markowitz published in 1952, but the mass version, the one a beginner hears today, was forged much later in the index fund boom that ran from the mid-1970s into the 1990s. Follow the timeline, because the account size is hiding inside it. When Jack Bogle launched the first retail index fund in 1976, it raised about $11 million and was mocked as un-American for refusing to try to beat the market. The people who bought in early were not beginners with a first deposit. They were established savers, professionals, retirees rolling over pensions, households with capital already accumulated. The advice that grew up around those funds was written for those wallets. Hold several asset classes, rebalance annually, keep a bond allocation appropriate to your age. Every instruction assumed dollars already on the table. Now the turning point. Somewhere in the 1990s, that advice detached from the balance it was designed for. Personal finance columns, then message boards, then the entire internet flattened it into a universal command. Diversify from day one. The dollar figure it silently assumed got stripped away. What remained was the shape of the rule, spread across 4, 5, 6 funds, repeated to everyone, regardless of whether they held $11 million or $1,100. This is the mechanism worth slowing down on, because it explains why the transplant fails rather than just asserting it. Diversification is not a property of a fund, it is a property of a dollar amount doing a job. A 3% bond allocation exists to dampen the swing of the other 97%, but dampening only helps when the swing is large enough to hurt. On a 6-figure portfolio, a 15% drawdown is tens of thousands of dollars, and the bond slice measurably softens that blow in real money. The allocation is earning its place. Shrink the same allocation to a $5,000 account, and the machinery keeps turning while the job disappears. 3% in bonds is $150. When stocks fall 15%, the position it is protecting moves by roughly $700, an amount that changes nothing about the saver's life, and that the next month's deposit can replace outright. The bond slice is no longer reducing meaningful risk. It is occupying space, generating a tax lot, and demanding a rebalancing decision, all to protect a swing smaller than a single paycheck. That is the consequence the flattened rule never accounts for. The instruction survived the journey from the 1970s, the context did not. What was calibrated for a portfolio where each slice held thousands of dollars now gets applied to slices holding hundreds, where the protective benefit rounds towards zero and only the friction remains. And the friction is not neutral. Every added fund is another expense ratio, another position to track, another cell in a spreadsheet that quietly whispers you should be rebalancing. On a large balance, those costs are trivial against the protection bought. On $5,000, the protection has shrunk to almost nothing while the costs held perfectly steady. The ratio inverts. So the loop this block was built to close can finally be answered directly. Was the diversification rule ever meant for an account this small? No. It was meant for the portfolios that first bought index funds, established, 6-figure, with slices large enough for the math to bite. The rule is not wrong. It is being prescribed to a patient it was never dosed for, which leaves the uncomfortable next step. If the protection barely registers at $5,000, the friction is the only thing left to measure. So what actually happens, dollar by dollar, when a beginner spreads that $5,000 across 5 funds? Split a $5,000 deposit across 5 ETFs, and the first casualty is invisible. Most of that money buys the same companies twice. Watch it happen with the 2 funds beginners reach for most. A total U.S. stock market ETF holds roughly 3,000 to 4,000 companies. An S&P 500 ETF holds 500. Sounds like meaningful variety until you look at the weighting. Because both funds are weighted by market value, the same handful of giants sit at the top of each. Apple, Microsoft, Nvidia, Amazon, the usual names occupy the largest positions in both. The total market fund's top 10 holdings and the S&P 500's top 10 holdings are, in practice, nearly identical. Buy both and you have not diversified. You have paid 2 expense ratios to own one portfolio. That is the number this block turns on. The overlap between a broad US fund and an S&P 500 fund runs above 80% by weight. $400 into the second fund might buy perhaps $70 of genuinely different exposure. The rest is a duplicate wearing a different ticker. Now the part the overlap hides: fractional drag and rebalancing friction. At $5,000, a 5-fund split means positions of a few $100s each. Some brokerages still buy whole shares only, so a $312 target becomes $290 of one fund, with $22 sitting idle in cash, uninvested, and earning nothing toward the goal. Multiply that across 5 holdings, and a meaningful slice of the deposit never actually enters the market. Then comes the maintenance. 5 positions drift apart at different speeds, so the rule now asks a beginner to rebalance, to sell a little of what rose and buy what lagged. On a taxable account, each sale is a reportable event. On $5,000, that paperwork protects a swing smaller than a weekend of overtime. So recalculate the whole thing honestly. Strip out the duplicated holdings, subtract the cash stranded by fractional gaps, and the 5-fund portfolio and the 1-fund portfolio hold almost the same underlying companies, except the 5-fund version costs more to run and takes longer to build. The diversification was mostly cosmetic. The friction was entirely real. Here is where the 2 scenarios have to sit side by side because the whole video has been circling this comparison. Scenario A: perfect fund selection. A beginner agonizes for 3 weeks, reads every comparison, and lands on the theoretically optimal 5 ETF mix. Suppose that flawless construction earns 0.1% more per year than a plain 1-fund alternative, a generous assumption given the overlap just exposed. On $5,000, 0.1% is $5 in the first year. $5. That is the entire prize for perfect selection at this balance. Scenario B: consistent deposits. A beginner picks one broad fund in an afternoon, then adds $200 a month without interruption. No optimization, no rebalancing, no second guessing. Over 1 year, that habit adds $2,400 of new capital to the account. Over 5 years, before any market return at all, it adds $12,000, more than double the starting balance, simply by not stopping. Set the 2 prizes next to each other. Perfect fund selection $5, uninterrupted deposits thousands. The gap is not close. It is not even the same order of magnitude. One decision moves the outcome by the price of a sandwich. The other moves it by the size of the whole account. If that math reframes what you thought mattered, the like button is the quiet way to tell YouTube that more beginners about to make their first deposit should see it. So the loop this block opens is really a question of leverage. Which decision actually moves the $5,000? The funds, where the best case edge is measured in single dollars, or the deposits, where the edge is measured in thousands? The comparison points hard in one direction, and it is not the direction the popular rule defends. Which leaves the discomfort that closes this block. If the funds barely move the number, something else must, and that something has been sitting in plain sight the entire time. The single dollar of edge from perfect fund selection is not a rhetorical flourish. It is roughly what the research keeps finding, and it points at a truth the popular rule never mentions. At this balance, the investor is the variable, not the portfolio. Start with the contrast the previous block set up, but push it into measured data rather than a stylized example. There is a well-known body of behavioral work, the quantitative analysis of investor behavior studies published by the research firm Dalbar, that has tracked, for decades, the gap between what funds returned and what fund investors actually earned. The finding is stubborn and uncomfortable. Over long stretches, the average equity fund investor underperformed the very funds they owned by several percentage points a year. Not because the funds were bad, because the investors interrupted themselves, buying after rallies, selling after drops, pausing contributions when the account felt scary. The money left in the market did fine, the behavior around it did the damage. Sit with what that implies. The largest destroyer of returns in the data was never fund selection. It was the human deciding whether to keep going, which means the lever that moves a $5,000 account is not sitting in a fund fact sheet. It is sitting in whether the next deposit arrives on schedule. Now the central truth, stated plainly. At $5,000, fund selection and deposit consistency are not two items on the same list. They are different in kind. One is a one-time choice, with a best-case payoff of a few dollars a year. The other is a repeated behavior, whose payoff compounds every single month it survives. Comparing them as rival options is the category error the whole beginner ritual is built on. Unfold that difference, and it grows. 0.1% of edge on a growing balance stays a rounding error for years, but the deposit does something the edge can never do. It changes the size of the thing the edge applies to. By year 5, the deposits have added $12,000 of raw capital, and now every future percentage point good fund or plain fund is working on $17,000 instead of $5,000. The deposit habit does not just add money, it multiplies the leverage of every other decision downstream. Fund selection can only ever nudge the returns on whatever capital is already present. Deposits decide how much capital is present at all. And the two interact in exactly the wrong direction for the 5-fund plan. The more complicated the portfolio, the more decisions stand between the saver and the next contribution. Rebalancing prompts, tracking spreadsheets, the low hum of, "Am I still allocated correctly?" Each one is a small invitation to pause. The Dalbar pattern is not a story about foolish people. It is a story about friction. And a 5-fund structure manufactures friction on an account where the protection it buys has already rounded to nothing. So the loop this block was built to close can be answered without hedging. Which decision actually moves the $5,000, the funds or the deposits? The deposits, and it is not close. The funds set the theoretical ceiling by a few dollars. The deposits set the floor, the ceiling, and the height of the walls. Thousands of dollars at a time, month after month, for as long as the habit holds. Everything in the popular rule optimizes the small lever and quietly endangers the large one. Reverse that priority, and a strange thing happens to the recommended structure. It gets simpler, much simpler. Which means the correct first structure looks almost too simple to be advice worth paying for, and that appearance is exactly the problem with explaining it. If deposits are the lever, then the correct first structure is whatever protects the deposit, and that single test rewrites the entire recommendation. Stop asking which mix is optimal. Start asking which mix a beginner will still be feeding, without hesitation, 18 months from now. Those are not the same question, and only the second one moves the balance. So the corrected rule for a first $5,000 is almost aggressively plain. One broad, low-cost fund. A single total market or S&P 500 index ETF held alone, with the whole deposit inside it and every future contribution flowing to the same place. No second fund for international. No bond sleeve to dampen a swing too small to hurt. No rebalancing schedule, because there is nothing to rebalance. One position, one decision, one automatic transfer. It looks like under-advice. It is the opposite. Every element stripped away was an element that either duplicated what the first fund already owned or manufactured a reason to pause. What remains is the structure with the fewest surfaces for hesitation to grab onto, which, at this balance, is the only structure that respects where the money actually comes from. Watch how it behaves in practice. Consider two beginners opening accounts in the same month, each with $5,000, and each intending to add $200 a month. The first builds the textbook 5-fund portfolio. The second buys one broad fund and sets an automatic transfer. 9 months in, the market drops 12%. Both accounts fall. But the first beginner now has 5 positions out of balance, a rebalancing prompt in the app, and a spreadsheet asking whether the international slice should be topped up. Each of those is a small doorway to the thought that maybe this month the deposit should wait. The Dalbar pattern lives in exactly that pause. The second beginner has nothing to adjust. The fund dropped, the automatic transfer fires anyway, and $200 buys more shares at a lower price. There is no decision to get wrong because the structure removed the decision. 12 months later, the difference between them is not in the funds. The underlying companies are nearly identical. The difference is that one of them kept depositing through the drop, and the other found a reason to hesitate. That gap, compounded across the years the account is meant to grow, is the whole game. Now the application, because a rule is only as good as the version a beginner can actually run on a Tuesday night. Pick one broad index ETF with an expense ratio in the single-digit basis points. Put the full $5,000 in it. Automate the next contribution, whatever the number, whatever the cadence, so it leaves the checking account before it can be reconsidered. Then close the app. That is the entire instruction. The sophistication is not in the holdings. It is in the deliberate removal of every touchpoint where a nervous beginner talks themselves out of the one behavior that builds the account. This is where the relief lands. The beginner who felt behind for owning only one fund was never behind. They had accidentally built the structure that gives the deposit habit its best chance to survive contact with a falling market. The simplicity was never a compromise. It was the point. But the simple rule has an expiration date, and it has a number. The one fund rule is not a permanent instruction. It is a phase, and it ends at a specific balance, which is the last thing this video owes you. Because the tension underneath the whole argument was never that diversification is wrong. It was that diversification was prescribed too early, to an account too small for it to do anything but add friction, which means there is a point where the friction flips back into protection, where a second fund stops being a duplicate and starts being a real hedge. That point is not a feeling. It has a rough dollar figure. Somewhere between $25,000 and $50,000, the arithmetic quietly reverses. Below it, a 3% bond allocation is a few $100s protecting a swing smaller than a paycheck. And the added expense ratios and rebalancing decisions cost more attention than the protection is worth. Above it, the slices grow teeth. At $50,000, a 15% drawdown is $7,500, no longer replaceable by next month's deposit. A bond sleeve now dampens a swing that would actually sting. An international position now holds enough capital to matter when US and foreign markets diverge. The machinery that spun uselessly at $5,000 begins, finally, to earn its keep. So the correct sequence is not one rule replacing another. It is the same principle applied when the dollars are ready for it. One broad fund until the balance is large enough that a second holding protects real money, call it the mid-five figures. Then add complexity deliberately, one layer at a time, each layer justified by the size of the swing it dampens. The beginner who started with one fund was never behind the textbook. They were simply early in a sequence the textbook forgot to write down. Which finally closes the question this entire video has circled. If diversification is the first rule of investing, why is it the wrong first move for your first $5,000? Because diversification is not a rule about funds. It is a rule about dollars. At $5,000, the dollars in each protective slice are too small to protect anything. So the only thing diversification does is manufacture the friction that stalls the deposit, and the deposit is the sole lever that grows the account into the size where diversification finally works. Follow the rule too early, and it quietly sabotages the very balance that would one day make it true. The rule is right, the timing is everything. So the honest first move is almost anticlimactic. One fund, automatic contributions, a closed app, and an untouched balance, growing by habit until it reaches the threshold where the old advice comes back to life. When it does, apply it deliberately. One fund now, or 5 funds now. Which structure are you actually going to keep feeding through the next downturn? That is the only question that decides the outcome, and you already know your own answer. Everything else was noise dressed up as prudence. The deposit builds the account. The structure exists to protect the deposit. And the diversification everyone rushed you toward is real, valuable, and worth every word of praise. Just not yet, and not at this number. This is education, not personalized advice. Wealth is built to last.